Welcome to Retiring Well. Listen, we got a great show for you today. We're going to talk about how Social Security gets taxed, the emotional attachment you might have to stocks and why you might want to avoid that, expense ratios as they have to do with mutual funds and exchange traded funds. Who is the Federal Reserve? What's their role, right? We're hearing a lot about that in the news. What is their role? And then we're going to talk a little bit about income riders as they have to do with annuities. A lot of people hear about these guaranteed accounts and usually those are associated with income riders. So today I'm going to teach you a little bit about those. So stay tuned.
Retiring Well, brought to you by Centennial Wealth Advisory, financial advisors specializing in retirement planning and serving all of Northern Michigan. Retiring Well, helping you plan for a successful and comfortable retirement. Retiring Well, plan to retire well.
All right, listen, in this segment, I want to talk about Social Security, but I want to talk about how your Social Security is taxed, how they calculate that. Now, IRS has a publication that has got a worksheet that takes you through it, but basically, it's as simple as this. You basically take half your Social Security and all your other taxable income, and you arrive at a number. Now, they call that modified adjusted gross income, okay? Again, you take half the Social Security that you're receiving, your other taxable income, and you arrive at a number, okay? Now, why is that important? Well, first of all, once I get that number, or what they call MAGI, or modified adjusted gross income, once I have that number, then they're going to look to see if I'm single or married, okay? If I'm single and that number hits $25,000, now from $25,000 up to $34,000, they're going to tax 50% of that Social Security you're receiving is going to be considered taxable income. Once you hit the $34,000 threshold, now 85 cents on the dollar of that Social Security is considered income. So two different thresholds there. Now, if you're married, it's different. The first threshold, taking half your Social Security and your other taxable income, is going to be $32,000. Now they're going to look at 50% of that as being taxable income, and then when you reach $44,000, now 85 cents on the dollar is considered taxable income. Now, how does that figure in? Once I figure in how much is taxable income for Social Security, now I can take my taxable income, that Social Security amount that's taxable, and arrive at my total taxable income. And then depending on what bracket I'm in is going to determine what my tax is. Now, we don't want to forget that we also have a standard deduction we get to deduct. So let me just run you through a calculation and how this might be. Let's say that I've got $20,000 in IRA income. I've got $24,000 in Social Security taxable income. So I'm going to take half my Social Security, right, $12,000. I'm going to take my IRA income of $20,000, and I'm going to get a MAGI number of $32,000. Now, if I'm married, that's the top of that first threshold where none of my Social Security is taxable, right? Because I didn't go over it. So now I've determined that none of my Social Security is taxable income. So what do I have left? I have my IRA income of $20,000. So that goes into the pot. But now I get to deduct a standard deduction if I'm married of probably $24,000, $25,000, $26,000, which is going to totally offset all of that. So I've literally got $32,000 of income between IRA and Social Security, and none of it is taxable. So you can see, folks, that knowing this and how my Social Security is going to be taxed is very, very important. If you're somebody that would like to know how your Social Security is going to be taxed, then I encourage you, give us a call. We'll sit down, look at your income, see what your tax liability is going to be, so you can have a great income plan. We here at Centennial Wealth Advisory realize that everyone has been affected by this coronavirus in one way or another. We watch our retirement accounts drop significantly in value, and we have questions. Can I retire in a recession? How will the coronavirus affect my retirement? How do I develop an income stream in a recession? Can I still retire this year? If these are concerns of yours, contact us today for a free initial consultation and learn what you can do now to help you weather the storm. Simply call 888-608-5825 or visit sunwealth.com and let us help you plan to retire well. In this segment, I want to talk to you about maybe having too much emotions with the stocks that you own. I think of the story of my wife's grandma. She inherited this stock from her parents. It was Dow stock, and it was all in one stock. It was all in Dow. And she wanted to pass that on to her kids. So what she did, though, is she kept it all in Dow stock. She felt like that because she received it as Dow stock, that's what she wanted to pass on. Now, I had to explain to her that, we might want to challenge that thinking because being all in one stock, if that stock went down in value, that account was going to go down in value as well. She had no diversification. So even though she had this emotional attachment to it because it was given to her and she wanted to pass it on, it wasn't necessarily the best thing for her to just hold on to it. I think of that a GE literally was a rocket scientist for GE, and GE had always done him well. He'd worked for him for years. He'd actually retired from GE, and he owned all this GE stock. Now, GE at one time would be a tremendous company to have ownership in. Of recent years, not so much. But I had a heck of a trying to talk him out of getting out of his GE stock because he had such an emotional attachment to it. Now, did it do well for some time after that? Absolutely. It was a good thing for him. But had he held on to that, again, in recent years, would not have been a good thing for him. I think that individual, when .com was such a big thing, this in the late 90s, remember, right before that recession we had between 2000 and 2002, and he was hearing about all these .com companies. He got a hot tip on a couple of them that were doing very, very well, but they had no earnings. And I was trying to explain to him, listen, this is not stocks you want to own when they don't have any earnings. And he wanted at one point to put everything in them. I talked him into only doing about 10%. Well, sure enough, what happened? Earnings did matter. That those stocks lost all their value in that recession, and he was so happy that he didn't throw all his eggs in that basket. Folks, earnings do matter. The market trades as a general rule at a multiple of its earnings. Historically, it's traded at about 17 times earnings. So when we see that multiple get a little bit higher, let's say it gets up there around 25, we can sustain that for a little while, and some people will jump ahead and do that because they see the earnings doing well in the future, so you can stand that. But folks, it's not going to be sustainable for long periods of time. Diversification is still the answer. You want to, again, don't want to have all your eggs in one basket. Don't get yourself caught emotionally holding stocks that you shouldn't hold. If you're somebody that has that concern and you want to see what proper diversification looks like for you, then certainly give us a call. We'd be glad to help.
Boy, I hope you found those valuable. Listen, again, we get this question a lot. People getting ready to take their Social Security. They might have maybe some small pension income. They got their IRAs. And so in tax planning, they're trying to figure out what account should I be pulling from, to minimize the tax the best I can. And they're unpleasantly surprised to find that, that some of their Social Security is taxed more because they're trying to raise their income in other areas. So, trying to find that sweet spot at which we can try to minimize the amount that your Social Security is taxed is critical. Sometimes we can't avoid it in the tax planning, so we pretty much have to accept that. Then it's a matter of maybe just maximizing the tax bracket they find themselves in. But very important to understand when you're doing tax planning, income planning. And then that, the emotional attachment that you have to stocks. What I always try to recommend to people is if you have to have that stock, if you want to ride that thing up, but you want to kind of protect yourself on the way down, then I would highly recommend, stop losses or trailing stop losses for that most part. For example, I can put a trailing stop loss on a stock to be 20%. Maybe that's what's acceptable to me if it happens to go the other way, that I can accept as a loss. So I can ride it up, but should it ever drop 20% from its high, then I know it's going to sell off for me. So, that's maybe one way to protect yourself if you have a stock that you feel like you have to own, but you can see why, diversification is very important. If that one stock you have does very, very well, that's going to bode well for you, right? But if it doesn't, boy, that can be awfully, awfully painful. So the other thing I'd like to talk to you about is what they call the sunken cost trap. You got this stock that you've had, it might be down, but you're saying, I got to hold on to it because, I've lost this much and I want it to come back. But truly, you want to look at that stock where it sits today. Even though there's a loss, if I can take that loss right now and take that money and put it into something that might do better going forward than what I was in, then honestly, you're going to want to do that, right? So don't get caught in that, I've got all this loss, I got to hold on to it just because, I want to come back. You got to look at it as of today. Can I get this into something more? So anyway, I want you to stay tuned because I'm going to talk about expense ratios. Next segment, and talk about the Federal Reserve. So stay tuned.
If you're retired or soon to be retired, let us help you plan to retire well. Centennial Wealth Advisory specializes in retirement planning and has offices in Traverse City, Cadillac, Petoskey, and Gaylord. We'll never pressure anyone to become a client. Our goal is to inform and educate. Simply attend one of our live events or schedule a meeting at one of our Northern Michigan office locations for a free, no obligation retirement review.
What are these expense ratios you find in mutual funds? An expense ratio is simply the general and administrative costs associated in running that mutual fund. It's their research costs. If they're running a fund and they've got an objective, then you want them doing the research as they study the companies and securities that they're putting in that mutual fund, right? It's their advertising costs. Folks, these costs are generally published in the prospectus that they have to give you. That's that little booklet that's got all the details about that mutual fund. What is its objective? What kind of securities is it holding? What's their strategy, right? And in there is going to be this expense ratio that they're going to tell you what those costs are. Now, in 2013, Morningstar did a study and they found that of all the mutual funds, they pretty much averaged about 1.25%. Now you're going to find sometimes mutual funds with much lower costs, especially if there's not a lot of trading associated with it, and you might find some that are higher, but they found the average to be about 1.25%. Now Barron's did a study in 2013 as well, and they found out of 1,800 mutual funds that they found this study did, they found that where the average expense ratio was 1.19%, the corresponding hidden costs were 1.44%. So, you ask, what are these hidden costs? Well, they're going to be the transaction costs associated with the buying and selling of the securities within the portfolio. You got to understand, when they go out and buy a security, there might be fees and commissions associated with that buy. And the same thing on the sell side. Well, those costs aren't going to be disclosed separately. They're just going to get attached to the securities they're buying and selling. So, just knowing that those costs are there is something you're going to want to know. Now, how do I know how high those costs are? Well, you're not going to know. But one clue might be if you look at the turnover ratio with that mutual fund, meaning how much buying and selling they're going to do. Well, there's reason to believe that one that's turning over much more is probably going to have higher transaction costs than one that's not turning over a lot. So folks, we can get behind these mutual funds and we can tell you, what the average expense ratio you're paying is in your mix of mutual funds, and we can tell you what those turnover ratios are within those funds. Isn't that important for you to know? Now, other things we can look at is cross-intersection. When you got mutual funds all owning maybe the same security, when you put those mutual funds together, what securities am I owning? Is there any low concentration of stocks in any one area? So folks, if that's something you want to know, if that's something you want to understand, then give us a call because we can do that for you. Hi, my name is Larry Flynn. I'm a financial advisor, senior partner here at Centennial Wealth Advisory. Listen, with this coronavirus, it created unprecedented times. High unemployment, you got a lot of businesses not reopening. Whether there comes a treatment or a vaccine for this disease, we don't know. There's just a lot of questions, a lot of uncertainty. But your financial well-being is still very important. And if you're in retirement or near retirement, then getting some good, sound financial advice is going to be critical. So in these unprecedented times, we're understanding that safety is a concern, and so we're offering a couple options. If you're willing to talk by phone or want to do a virtual meeting, whether that be Zoom or something like that, we're offering that ability to do that. If you're somebody that does want to meet in person, we're trying to accommodate that as well. We're saying, we're not going to have any two clients meet at once. We're sanitizing it before and after you're here, and we're keeping the proper social distancing in place while we meet. So if these are a couple options you might want to pursue, we encourage you to just give us a call on the number that's on the screen, or visit our website at cen-wealth.com, and just basically you can set up a meeting there. Stay safe. If you have some financial concerns and need to address those, then certainly give us a call. All right, in this segment, I want to talk about the Federal Reserve. Now, you hear about them in the news a lot. It seems like, when they're lowering interest rates, the markets are going up, and when they're raising interest rates, the market's going down. Why are they responding so sensitively to what the Federal Reserve does? Well, there's a lot the Federal Reserve is responsible for. Now, they were created in 1913. Now, there was a lot of discussion at that time whether they should be a private organization or a government organization. And there was a lot of controversy on Congress which way this should go. In the end, they ended up compromising. The board of the Federal Reserve is made up of government appointees and also CEOs of private large central banks. So it's a little bit of private and government in the mix. Now, what is their objective? What is their goals? First of all, they have a dual mandate. They want to, one, keep currency stable, make sure our currency is stable in the country, but they got a dual mandate in the sense that they want to control inflation and have low unemployment. Now, these two things are kind of opposed to each other, because typically when you've had very low unemployment, inflation will go up because people's wages grow and there's higher demand than there is supply, and prices go up, and they don't want inflation to get out of whack. Now, they like to see inflation be about 2%. Now, we've actually had that for quite some time. So how do they do this? Well, they control the money supply by buying treasuries, okay? If they go out and buy treasuries, they're basically increasing the money supply because they're putting money into the economy. But they can contract that money supply by selling securities, okay? So that's how they kind of do it. The other way they control the economy or the money supply is in the interest rates they charge. They become the bank to the banks. So when the banks need money, they borrow it from the Federal Reserve. Well, the Federal Reserve will loan it out to them at a certain interest rate. All right, that kind of becomes the baseline. So if the Federal Reserve is wanting to lower interest rates to fuel the economy a little bit better, then they're going to lower that federal rate in which they loan to the banks, which allows them to loan it out to everybody else at a lower rate. Okay, but here's all that being said, and trying to control the money supply, the biggest goal or objective for the Federal Reserve is to make sure there's no run on the banks. Okay, if you've ever seen that movie, it usually comes out at Christmas time, called It's a Wonderful Life, with George Bailey, maybe played by James Stewart. Remember what happened? All the people came to the credit union and they wanted their money right now. And James Stewart or George Bailey had to tell them, listen, your money's loaned out with this person, it's loaned out with that person. I can give you some of it now, but not all of it. That's what the Federal Reserve does to all the major central banks, so that there can't be a run on the banks and have it be detrimental to our economy. So hopefully it just gives you some tidbits about the Federal Reserve, maybe helps you understand a little bit about their role, which happens to be quite huge. Well, anyway, I hope you found that interesting. Hey, if you want to talk a little bit more about the Federal Reserve and maybe the impact it might have on your portfolio, then certainly give us a call.
Welcome back. Boy, I hope you found those valuable. People get those prospectuses, and it's a lot of fine print, and I hardly ever find anybody reading them. Advisors are supposed to tell their clients they really need to read them, but it's helpful to know what you're paying, what those costs are. Now, I know exchange traded funds as a general rule, because there's no trading going on, enjoy lower fees, but typically you'll find that they are there, and those fees are prevalent in accounts. So knowing what they are is very important. But boy, talk about the Federal Reserve. You can see what their role is. It's huge. And in recent years, it seems like they've even taken on a greater role. Since the last recession in 2008, their balance sheet was $1 trillion. As of the airing of this show, it's now $7 trillion. And I'm not sure when this, at the end of this pandemic, that it's going to be maybe close to $10 trillion. So since 2008, what are we talking, 11, 12-year period, they've grown their balance sheet from 1 trillion to maybe $10 trillion. Folks, that's a lot of money being printed. It's scary because, with the national deficit, the idea that every year our government is spending more money than it's taking in, where's that all going? How long can we just continue to print money and then grow ourselves out of that? So definitely some times we haven't been in before. And debt is certainly a big issue that I think we're as a nation going to be talking about more and more as we go forward. But as you hear more about the Federal Reserve and their role in this, and it's certainly been a big role, maybe having an understanding of what they are and who they are and why they do what they do, you found valuable. So anyway, watch this, stay tuned, because in the last segment, I'm going to be talking about these income riders. Now, they're mostly associated with insurance products, most particularly with annuities. So I hope you find it valuable because they are interesting. There's some words like guarantee you hear, but I want you to know what the difference is. So stay tuned.
We here at Centennial Wealth Advisory realize that everyone has been affected by this coronavirus in one way or another. We watch our retirement accounts drop significantly in value, and we have questions. Can I retire in a recession? How will the coronavirus affect my retirement? How do I develop an income stream in a recession? Can I still retire this year? If these are concerns of yours, contact us today for a free initial consultation and learn what you can do now to help you weather the storm. Simply call 888-608-5825 or visit sunwealth.com and let us help you plan to retire well. Welcome. Now in this segment, what I want to talk about is what we call income riders. Now, folks, these are things associated with insurance products, okay? The two I want to talk about today are what are called variable annuities and fixed index annuities. Now, these can be very complicated financial instruments, but I'm just going to try to touch on some basic things that you need to understand when you're looking at these kind of financial instruments. A lot of you have these out there and you don't even know what you have. So let me kind of walk through how to kind of look at these. First of all, you have what's called variable annuities, all right? Now, these are, again, insurance products, but they'll typically have two sides to the investment. First of all, they'll have an account value side. Now, on the account value side, it's just like any kind of an investment account. There's investments within it, and it can grow if markets are cooperating, or it can go down if not. Now, they look similar to mutual funds, but they call them sub-accounts. And again, you have to understand that the account value can go down if the markets don't cooperate. Now, they have another side to them called a guaranteed withdrawal income benefit. Now, this is where you hear the word guarantee, but you got to be careful because any kind of a guarantee when it comes associated with insurance company is only backed by the full faith credit ability of that insurance company. So you got to be very careful. But what the insurance company is going to give you is some kind of guaranteed growth, or some growth that gets ratcheted up or reset every time the market cooperates and then can't go down. So a lot of people will think, oh, I got something that's guaranteed. That's very true as it relates to the income, okay? Because at some future date, whatever this amount is, you can trigger a lifetime income that's guaranteed, but it doesn't mean that the account value can go down. I see a lot of people that got these variable annuities with the account value down here because it took market risk. This guaranteed income benefit that might be here, but that's the only way they're going to get any benefit is if they trigger it that way. Now you have also what's called fixed index annuities, a little bit different. They also have two sides similar to the variable annuity, but on this side it's an account value usually tied to some kind of an index that can't go down in value but only go up. based on how much participation they're going to give you or whether they put a cap on it or not. But it's an instrument that can go up but can't go down. But it also has a guaranteed withdrawal income benefit that can grow guaranteed as it does with a variable annuity. Now they're all different, all right, but you have to understand the differences between these. Now the other thing you have to understand is that to have this guaranteed withdrawal income benefit, many of them are going to charge a fee to this side. And knowing what those fees are is very, very important. The other negative with these kind of financial instruments is the insurance company is going to require you to be connected or obligated to it for some period of time. Very similar to like a long-term CD or such. Otherwise, there's some penalties associated with it. So hopefully this gives you just a little basic understanding of them. If you have one of these financial instruments and you really want to know what you have, then give us a call.
So when we're doing income planning, folks, we like to carve out an income stream. We look to whether or not somebody has pension income, because that's a guaranteed payout. What's their Social Security going to be? And we try to look at that and say, do they have any need for any more income other than that? If so, we want that income stream to be protected. So using what we call a bucket approach, we want to segment aside the money that we want to be associated just for income. Now, as you understood with those income riders, that can be one method in which to satisfy that difference. If I've got that pension, Social Security, and then I know how much I need here, well, if I can come up with a financial instrument such as a fixed index annuity, or a variable annuity that can carve out that guaranteed income for me. And so that now I know that all my income needs are met. Then with the rest of my money, I can have it in the traditional kind of growth buckets. So that might be a way to use that. I think a lot of people call those guaranteed income accounts. It's kind of likened to a private pension. The idea that I can take money, put it into this instrument that will maybe grow and not lose, and be maybe sometimes guaranteed to be a certain amount at a certain time at a guaranteed percentage, kind of like setting up a private pension. So they can be valuable under certain circumstances, but certainly understanding what they are and how they work is very important. So folks, I want to encourage you, if you're somebody that needs tax planning, you need income planning, you're getting close to retirement and you really want to know what that looks like for you. Maybe you have a portfolio and you want to know what you're paying in fees. Maybe that person just wants that tax planning as well. Folks, I encourage you, give us a call. The number's on the screen, or visit us on our website at cen-wealth.com, which is also on the screen. It's a no obligation free visit to meet with us. We're trying to be respectful of the social distancing. We're not allowing more than 2 clients in at the same time. We're sanitizing before and after. So if we can have that meeting by phone, great. If we can have it by Zoom, great. Or if you want to visit us face to face, we're trying to accommodate that. So hopefully you found today's show valuable. We'll see you next week.